that you'll be, that Dr. Macmillan will be taking you through this morning. It will also be mailed to all of you, so you don't need to spend your time taking too much notes. So let me just pause and hit the record button, and then I'll introduce Dr. Macmillan. Okay. So Dr. Macmillan was here last year. As I've said to the other two workshops, he's now considered an honorary Jamaican. He joined the CFA Institute in October 2008 after more than a decade as a professor of accounting and finance at Johns Hopkins University, Carey School of Business, as well as at George Washington University School of Business, two prestigious institutions. Prior to pursuing a career in academia, he was a securities analyst as well as a portfolio manager at Baylor, Beale, and Kaiser, and Meros Capital Management in San Francisco, California. In his current role as Director of Ethics Education at CFA Institute, Dr. Macmillan is responsible for creating and developing educational content for CFA Institute members, for investment professionals, in ethics professional standards. Also, he's responsible for providing ethical decision-making workshops such as this for pension plan trustees, for regulators, for investment professionals, even university students. Dr. Macmillan, he has a PhD in accounting and finance from George Washington University. He has an MBA from Stanford University and a BA from the University of Pennsylvania. He's a chartered financial analyst. He's a certified compliance and ethics professional. He's a chartered investment counselor, and he's a certified public accountant. There's much more I could say, but in the interest of time, I'm going to pause right here and hand you over to Dr. Macmillan. Mike, over to you.
All right, thank you very much, Hugh. Let me just get my screen. Here we go. Let's see, share. Let's get this up. Play from start. Okay, good morning, everyone, and thank you very much for attending this workshop. I hope you find it not only educational, but enjoyable as well. As Hugh mentioned, it's interactive, and here is how we're going to approach this. Ethics is a key part of the CFA program and a key component of the 3 levels of the CFA exam. Every ethics question on the CFA exam has 1 right answer and 2 wrong answers. But as you all know, most ethical dilemmas don't have clear right or wrong answers. They all occur in that gray area. So today what I'm going to do is I'm going to place you into some real life ethical dilemmas that investment professionals have told me they have faced. And then I'm going to give you an opportunity to vote anonymously on what you would do if you found yourself in a similar situation. So give you a chance to vote. We'll look at the voting results, and then we'll talk about some of the ethical issues that are involved in each situation. As Hugh said, we have a small group. There are nothing but regulators, your colleagues within this group. So I really do want to encourage you to ask questions, to make comments, to provide us with feedback, and don't feel concerned that there are people from outside who may be listening or whatever, because they absolutely are not. So with that, we will begin the presentation. You know, I wanted to start with the mission statement of CFA Institute. We've been in business for 73 years, but over the last 12 years, we actually changed the mission of our organization. Prior to 2008, meaning prior to the financial crisis, our mission was to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence, period. Then 2007 and 2008 occurred, the global financial crisis. And as most of you know, as a result of that crisis, many people lost their homes, even more people lost their jobs, and even more people lost their life savings. And we began to think about this at CFA Institute, and we realized that if we were able to raise the educational standards of investment professionals in our industry, and if we could increase the ethical behavior of investment professionals in our industry, that is what would ultimately benefit society. So that's why we added that last line, for the ultimate benefit of society, in 2009. So I just want to show you this chart just to emphasize the global nature of the CFA designation and the CFA program. There are currently about 185,000 CFA charter holders around the world. There are 158 CFA societies from around the world. And one of those societies, of course, is CFA Society of Jamaica. When you look at our makeup of charter holders versus candidates from this graph, you will see that the majority of CFA charter holders are in the Americas. Canada, the US, South America, 101,992. However, when you look at registrations or candidates entering into the CFA program in the Asia Pacific region, you will see that there's 199,000 or almost 200,000 candidates coming from China, Hong Kong, Singapore, and India. I show you this just to emphasize, one, the global nature of the designation, and two, to show the growth in our programs across the world. And one of the reasons for the growth in the program, as I mentioned earlier, was the ethics component. There are 3 CFA examinations. Ethics accounts for 10 to 15% of each level of those exams. In addition, as a CFA charter holder, so myself, Hugh, Brian, who's president of the CFA Society, and Narisha, as charter holders, we have to sign an affidavit, a sworn statement every year saying that we've lived up to and upheld the CFA Code of Ethics and Standards of Professional Conduct. Now, this does not guarantee to an employer or to a regulator that all CFA charter holders are going to be ethical, but it certainly increases the probability that that will be the case. So, enough of my commercial about the CFA program. Let's talk about ethics. And this is what we mean when we say ethical behavior. It's doing the right thing when no one else is watching, even when doing the wrong thing is legal. You know, one of the reasons why the investing public was so angry with the investment industry after the financial crisis is because so many of the activities that led up to the financial crisis were legal, not ethical. And as regulators, you know that the law really represents the minimum level of behavior that people must follow, and that ethics really represents a much higher standard. So as regulators, you tell investment professionals, this is what you can and cannot do. What we're trying to do at CFA Institute is not focus upon what investment professionals can and cannot do. We're trying to focus upon what investment professionals should or shouldn't do. That's really what ethics means to us. And in terms of defining ethics, this is how we define it. Ethics has to begin with education. Investment professionals must, of course, understand investment products, investment markets, and understand economics, etc. In addition, investment professionals need to understand the laws, rules, and regulations in the jurisdictions in which they're doing business. So ethics has got to begin with education. Equally as important, ethics requires trust. And it's important to understand that trust is earned, not given. So in order to be ethical, it's important that investment professionals demonstrate through their actions that clients can trust them. Ethics also requires honesty, integrity, character, and this last one is stewardship. And let me just explain what stewardship is. I'll use the analogy. Think about the last time you went to the doctor. You went to the doctor because you weren't feeling well or something hurt. You go to the doctor, you explain to him or her what is bothering you. They in turn ask you a series of questions, perhaps give you a checkup. And at the very end of your appointment, they sit you down and they tell you exactly what you need to do in order to get better. Think about that moment. As that doctor is telling you what you needed to do, was there ever a doubt in your mind that what that doctor was telling you was not in your best interest? I dare say no. You see, we entrust our health and body to our doctors, and in return, we expect them to carefully and responsibly manage our health solely in our best interest. As investment professionals, we are stewards of our clients' money. Clients are entrusting their money to us, and in return, they are expecting us to carefully and responsibly manage their money solely in their best interest. I love this quote. The financial services industry is at its very core all about the concept of stewardship and all about stewardship values and responsibilities. After all, the foundation of financial markets is public trust and confidence. And again, as your role as regulators, part of your responsibility is to ensure that the public does feel trustworthy and confident towards those who are involved in the financial markets. So, here's some quote that I got and modified about the pandemic, about the current pandemic. Warren Buffett many years ago said, "Only when the tide goes out do you discover who's been swimming naked." Well, I modified that and said, only when the market declines do you discover the true risk of investment products. You know, this is a key lesson from both the 2008 financial crisis and the current pandemic. When we experience volatile markets or huge declines in the markets, the true risk of all of these investment products that have been sold to clients really is revealed. You see, when markets are going up, people will invest in anything without really understanding the true risk of the products or securities that they are investing in. So with market declines, that's when the problems become more apparent. So some lessons from the crisis are these. Financial planning and financial preparation are as important as asset allocation. Oftentimes, clients come in and talk with an investment professional, and they are focused upon how much money should I allocate to fixed income, how much money should I allocate to stocks, to real estate, etc. Although that is important, what is equally as important is financial planning and preparation. Does the client have enough funds available in case an emergency happens, in case something happens with the economy? That's what we mean by financial planning and preparation. Not to plan for the good times or prepare for the good times, but to plan and prepare for the bad times or the crisis times as we're seeing right now. Secondly, investment professionals have to focus more on risk and the downside and place less focus on potential or expected return, i.e. the upside. Everybody wants to talk about return. Oh yes, you could get 8%. Yes, you could get 12, 15%, but nobody wants to talk about how much a client could potentially lose in a variety of different situations. So greater focus on risk and the downside is very important. Greater focus on liquidity. Cash is and will always be king, regardless of the low returns it may generate. I know that now some investment professionals can invest in alternative assets such as private equity. Now, private equity may be an appropriate investment, but it's important for not only the professional, but the client to understand that this is a relatively illiquid investment. And so in order for it to be suitable for the client, that client must be willing to have a holding period of at least 5 to 7 years. Same way with equities. Equities are great long-term investments, and any client who is interested in investing in stocks should have a minimum holding period of at least 5 years. Case in point, right now, we see the markets not only decline, but are being very, very volatile. That's okay if you don't need the money that's invested in equities for the next 5 years. It's a problem, however, if you were just parking money or investing in equities for a short-term for some short-term objective, because now you're probably going to have to sell to raise cash in one of the worst times in the global stock market. So long-term investments. Another thing, clients must understand the features and characteristics of their investments. They must understand, because ultimately it is the client's money that is being invested. So they are responsible to understand that, and they must demand from their investment professionals to explain to them the products and features of what these investment professionals are recommending. And if the investment professional is unable to do that, then the client should not be investing in these products. Same thing. Investment professionals must have a greater understanding of the investment products and strategies they recommend, as well as question the underlying assumptions about the product's expected performance and risk. Here's the problem that we found as a result of 2008 particularly, as well as currently right now. The investment professionals didn't understand a lot of the features and assumptions of the products that they were selling their clients. So if the investment professional doesn't understand it, how can the client understand it? So this is really imperative. And lastly, investment professionals must not recommend any product that is promoted in a misleading or oblique manner. And again, as regulators, I think you have some responsibility to ensure that this does not happen. You know, I'm just going to step aside for 1 second and say, back in 2008, Lehman Brothers, which is no longer here, was selling these principal protected notes to clients. And the product was sold as being 100% guaranteed. And yes, the product itself was 100% guaranteed, but it was guaranteed by Lehman Brothers, not by the US government or by some other outside agency. So when Lehman Brothers went bankrupt, all of these notes all fell to zero because the principal guarantor of those notes went bankrupt. This is what I mean when I say must not recommend any product that is promoted in a misleading or oblique manner. Before I go on, does anybody have any questions or comments or want to say anything? Please do not hesitate. Don't forget to unmute yourself if you do.
I'd be surprised if Carnell doesn't have a comment. Carnell, good morning.
Yes, hi Carnell. Please speak up, unmic yourself.
Good morning. I don't have a comment at this time, but definitely I will chime in as we go on.
Okay. All right. Great.
Just pulling Carnell's leg.
All right. All right. Let's see. All right. So here we go. Now, here's the fun part of the workshop. I'd like everyone to get out their cell phone, or you can even do it on your laptop or an iPad, and go to this website, www.slido.com. All right. And once you go to the website, your login is going to be CFAJ, and it doesn't have to be, and it's not case sensitive, so you can use small letters, capitals, or a combination thereof. All right. And I'll go back. I can come back to this slide. Are we there yet? As a matter of fact, why don't we do this? Let me see you raise your hand if you're ready. All right, raise your hand if you're ready. I see Richard is ready. Abby. Jed. All right. Ophelia, thank you. Yeah. Ian, hot dog. All right. Abby. Good. Good. Come on, Juanita. Lloyd. Reynard. All right.
And Michael, this is Nicole. I've also put the link and the code in the chat group if you need it again.
Okay, great. All right, so I'm going to go ahead And here we go. Here's our first case. Now, I'm going to do 2 cases in a row, but I want you to know that both cases are true stories, and I'll tell you what happened afterwards. So here is our first case. And the case says, your boss who hired you and has mentored you for the past 3 years is being unfairly let go because of office politics. As the sole support of her family, she is concerned about finding another job. So a week before she is scheduled to leave, she places a stack of files on your desk and asks you to copy them because she will need them in her job search. Now, the files contain research reports that she wrote, marketing presentations containing her performance record, and spreadsheet models that she created. So what do? Do you A, copy the files? B, refuse to copy the files? C, only copy the research reports that she wrote? Or D, only copy the spreadsheet models that she created? So I'm going to give you a moment to think about this, and then I'm going to ask you to vote. All right, I see some votes are coming in right now. Good. Now, just so that you're not influenced by what other people are saying, I'm going to switch back to the presentation. All right, don't be shy. All right, all right, good, good, good. All right, so I'll let you guys finish voting on that. I'll give you a couple more seconds. All right, so now we're going to go right to the next one, and then I'll come back and talk about both of them at the same time. Okay, so, all right, let's go back to here. All right, so here's our second case, which is very similar to the previous one. Your boss who hired you and has mentored you for the past 3 years is being unfairly let go because of office politics. As the sole support of her family, she is concerned about finding another job. So for the past week, you have observed her making copies of the research reports that she wrote, marketing presentations that she made, and spreadsheet models that she created. She then places this information in her briefcase before going home. When you ask her what she's doing, she tells you that she will need to show prospective employers examples of her work. So what do? Do you A, do nothing? Do you B, help her copy the files? Do you C, give her a thumb drive to use to copy the files onto? Or do you D, tell her that you will send her the files after she leaves? Okay, again, vote. What do? All right. Okay, we love this. All right. All right, come on, slow pokes. Okay, so I'm going to close the voting for this one, and I'm going to go back to the previous case. Now, what is the issue? Now, in the previous case, 75% of you said refuse to copy the files. 13%, 6% said copy, 13% said only the copy the research reports that she wrote. So I ask you, what is the issue in this particular situation, or is there an issue in this particular situation? All right, this is when you get to respond. And remember, there's only us here. So, hey, Carnell, can I ask you, what's the issue to you in this case?
Everyone. Well, I think the main issue is the work and models that she would have created while she was at the employer, that is the property of the employer and will remain so going forward. So as someone who she's asking to actually assist in actually breaching,
Yep.
to help her, that's something that I wouldn't be able to participate in. In fact, I would actually point out her, the general standards pertaining to that and why it is unethical.
Okay, but Carnell, I agree with you, but Carnell, this is your boss. This is the person who hired you and had mentored you for the past 3 years. This is the boss who you believe is being unfairly let go, and you know she needs this material to help her find another job. How are you going to refuse?
As you put it, it sounds quite emotional and personal, and I understand that. But generally, the standards are clear, and we want, as we execute our duties to protect our clients or our employers, to ensure that we follow the rules, and that's something that we have to work towards on a daily basis.
Great. Thank you very much. Great answer, whatever. I do have to ask you one question, though, because I want to go to the second case. What was your response in the second case?
Well, to be honest, I don't feel that the correct answer is there.
Okay.
I actually selected A, which is nothing, because I thought that is the best out of the lot.
Okay.
Because it's quite similar where the models and the like that she would have worked on marketing presentations, those are, that's a property of the employer and shouldn't be taken.
Okay. Okay. So here's my question. And again, I'm not picking on you or anything else like that.
No worries.
But if you do nothing, then isn't that sort of allowing her to steal the material?
It is, but as I said, it is the lesser of the other evils that are there in terms of helping her to copy the files, telling her, it's tantamount to, let's say, D. You could tell her that you're going to send it after and you don't send it. It's just about doing nothing, either if you don't send it. But if you send it after, you'll still be involved in committing a breach of the standards, and giving her a thumb drive that is still a little bit worse than A. So whilst I don't think that A is the best thing that should be done, I think it's the best response right here.
Okay, great. Thank you very much. I really appreciate that. Okay, so here's the situation is, yes, everything that you do at your employer is the property of the employer. So in the first case, when she is asking you to help her copy the files, well, in effect, what you're doing is helping her steal company property, and you're almost as guilty as she is. But here is what happened in the real life situation. This individual copied the files. Because how can you refuse someone who is A, still your boss? How can you refuse someone who hired you and mentored you, who you believe is being unfairly let go? So this individual copied the files. They felt uncomfortable about doing it, but they copied the files nevertheless. So a week later, the boss leaves. It still bothered this individual. So this individual went to the boss's boss to explain, to tell the boss's boss what they had done. Well, the boss's boss was not happy that this individual had copied the files, but they certainly understood the situation that this individual felt that they were in. So that's case one. Now, the interesting thing about case two is that many people have no problem with watching what the boss is doing and saying nothing, only because they are not actively involved in this theft. But the actual outcome of the two events, of the two situations, are still the same. The boss is going to leave with company property. And people, although they witness an unethical act, feel like they're not involved or do not generally feel compelled to say something about it since they are not involved in it. Everybody with me on that? It's easier to just sit by and do nothing and let someone behave unethically, as opposed to actually getting involved and doing something unethical themselves. And one of the reasons why I like this case, these two cases, is because it really illustrates something about how we make decisions, sometimes when faced with an ethical dilemma. And the points I want to make is this: we make most of our decisions instantly and instinctively rather than rationally and using reason. So we see a situation, we decide immediately what we're going to do, and then later we think back and say, I don't know whether we should have done it or not. Secondly, we tend to believe that we are more ethical than we really are. Third point is this: we often make unethical decisions not because we are bad people, but because we're often affected by psychological biases, social and organizational factors, and situational influences. It's these things that come into play and can affect our decision-making. So I think what this really all is saying is that there is a difference between unethical behavior and unethical people. And most people who get into trouble are actually not bad people. They just found themselves in situations or circumstances that resulted in their making the wrong decision as opposed to the right decision. So what are some of these biases and factors and influences? Well, first one is obedience to authority. Generally, our boss asks us to do something and we do it without really thinking about, well, what are the ethical implications of what they're asking us to do? Now, I do want to say this, that our level of obedience to authority is actually a function of age. When we're in our 20s, we are much more ready to obey authority, since we have been told since we were 0 to our 20s, obey your elders, listen to what we say, don't question what we ask you. As we get older, however, we are more questioning. So in the case of the files, that case that I just showed you, the individual who that actually happened to was 24, 25 years old. So obedience to authority. Secondly, conformity bias. We all have this tendency to follow the crowd and to conform our behavior to that of our peers. So we see everybody else doing something and we say, well, if they're doing it, we can do it as well, without really thinking about what are the underlying ethical issues surrounding what all of these other people are doing. Incrementalism, that gradual shift or slide down the slippery slope, if you will. If you study investment, if you study embezzlement situations or fraud situations, take Bernie Madoff. I'm sure you all are familiar with Bernie Madoff. Well, Bernie Madoff did not wake up one day and say, I'm going to steal $50 billion or whatever that number was from my clients. No, it didn't happen that way. It happened slowly over time, and the theft just got bigger and bigger and bigger. Last factor is overconfidence. Sometimes, as I said in the previous slide, we think that we're more ethical than we really are. And we have this attitude, I'm more ethical than they are, it won't happen to me. And that's a very, very dangerous attitude to take. Because when you have such confidence in your own ethics, it means that you are not stopping and thinking about the potential consequences or the perceptions of what you are about to do before you do it. Okay, so these are just some of the biases, factors, and influences that can affect or lead to unethical behavior. Here's a great, yes?
All right, before you move to the next slide,
Yeah.
our poet raised a very interesting point in the chat. Just we're in the art of a regulator, and the point he has raised is that there can be a case in which doing something can actually endanger your life, which is a reality in Jamaica as a regulator and oversight body. The former boss may have ties to unsavory characters, will be tasked to eliminate you. And so I guess the question is thrown out to you with the two cases that we went through. If you're wearing the hat of a regulator, does that introduce any kind of unique consideration in terms of how you would have dealt with those two cases which you presented?
Right. Okay, so here's the thing. We don't even have to go to your life. You could feel that you are going to be fired if you don't do what the boss has said. And there's a quote that I sometimes use from this professor at Loyola University. And he said, ethics can be dangerous to your career because you may be called upon to do things that turn out to be unethical or illegal. And here's the problem. As if you are in a position where you're fearful for your life, or you're fearful for your job, so you do something that's illegal. Well, as a regulator or as the judge, this individual is not going to care that you were in danger. They are just going to care that what you did was illegal and that you shouldn't have done it. So, I mean, I think your life is an extreme situation, but it's going to be very hard for people who are not in your situation to be able to sympathize, to say, oh, the only reason why you broke the law is because you were afraid of losing your job, or, of course, at the extreme, afraid of losing your life. Did I answer that? I hope so.
Perhaps our poet could just unmute and say whether or not that response had given him a little more settledness in his spirit.
All right. Well, see, here's the, yeah.
Go ahead and
Yeah,
tell
I
us
understand your answer, your response.
Pardon?
Oh, I understand Mr. Macmillan's response.
Yeah.
What does the R stand for, by the way?
Roger.
Roger.
Roger Powell. Yes.
Yeah.
Okay. That's a famous name. Welcome, Roger.
Yes, thank you.
But to your point, here is this quote that really addresses the issue that you raised. Sorry. And the quote says, situational influences have more to do with unethical behavior than a person's character. Under the right conditions, good people, and I mean all of us, can be induced, seduced, or initiated to act unethically. I mean, how many times have you read the paper and you've read about someone who's done something absolutely unlawful, illegal, or just stupid, and you think to yourself, oh my God, how could this person have ever done something like that? Well, the fact is, we don't know what the particular situation was or what the particular circumstances that individual faced, which resulted in their making the wrong decision as opposed to the right decision. So, to your point, you may feel like that you have no other choice but to do something unethical, not because you are a bad person. It's just that the situation you find yourself in provides you with no other alternative but to proceed down that wrong or unethical path. Okay? All right, keep those questions and comments coming. Here is our, I'll turn on the voting. We go back. All right, so your boss, a fixed income portfolio manager, is attending an investment conference. During dinner, an analyst from Glitch Ratings mentions to your boss that his colleagues are working on an impending ratings downgrade of APAC Corporation bonds. Because several of the portfolios he manages contain APAC bonds, he calls you at home and tells you what the Glitch analyst said, and then instructs you to sell APAC bonds from all client portfolios when the market opens. The next morning, you sell all APAC bonds from client portfolios. You then call your broker and tell her to take a short position in APAC stock in your portfolio. So, have you done anything wrong? No, because you are following your boss's instructions. B, no, because you owe a duty to your clients. C, yes, because you should not have sold APAC bonds from client portfolios. Or D, yes, because you should not have taken a short position in APAC stock. So, give you a moment or two to think about it and then vote. Have you done anything wrong? Let's check out the voting. All right, let's see, how are we doing? All right. All right, the votes are coming in. All right, come on, we need 5 more people. Again, remember, all of this voting is anonymous, so don't worry about it. All right. For time purposes, let me go back. There's still time to vote. So let me ask our audience, what is the issue here? Someone want to volunteer, or do I have to pick on somebody? Sharifa? What do you say? You can unmute. We'd love to hear what's the issue here. You don't have to tell us how you voted, but what's the issue?
I just joined. I haven't even read the scenario just yet.
Oh, okay. All right.
Yeah, Sharifa just came on about a minute ago.
Oh, my apologies.
So
No.
Sorry about that.
that's fine.
That's
So
okay.
Mike, you
Nice
could
to
pick
meet
on-
you, Sharifa. Hey, Chad. Hey, Chad, what's the deal? You can unmute, Chad. Chad's very quiet. How about Ian? Ian? What is the issue here? We need a volunteer. Yes.
Colonel here, let me take a try.
All right.
So,
thank you.
I think the ethical issue here is conducting a trade or a series of trades that were initiated from material non-public information.
Okay. Okay. Yes. I would say that the information, but what do? Don't you owe a duty to your clients? Don't you owe a duty to your boss as well?
Well, as investments professionals, you base on, and you're part of the CFA Institute. Let's say that the investment manager is a CFA charter holder. That person has a duty to uphold ethical standards, and part of it is to ensure generally the orderly functioning of the financial markets, and trading on material and public information is something that is totally against that. So as you rightfully said in the previous scenarios, persons understand what it takes to be ethical, and they are generally ethical, but the situations that they are presented with, sometimes when you look in this case, it may be conflicting, because the manager would want to generally improve his performance, which will generally increase businesses to come in under his management. But as you rightfully said, the principle here is not trading on material non-public information, because that will generally give him an unfair advantage over other market players.
But the problem is, Carnell, let's suppose that 8% of your clients' portfolios are invested in APAC bonds. So you know that your clients are going to take a significant loss or experience a significant loss if you do not sell these bonds. Can you tell a client, well, I know this information, I could have prevented this loss, but I just didn't want to?
Well, I guess these are the challenges of operating in the industry.
Yes, yes.
Because what you have to also look at, you look at the immediate impact on the portfolios and your general long-term performance and your returns. However, there are legal implications if it can be proven that you actually traded on this type of information. So it's something that you would have to balance. So it's not only looking at the client's interest, it's also looking at your reputation. And generally, how everyone should look at it is the impact on the financial system itself.
Okay, all right. Yes, I agree with you. And by the way, although in the CFA program, we do have a prohibition about acting upon material non-public information, we also have a standard that says that we have a duty of loyalty, prudence, and care for our clients as well. I'm not justifying the answer, but let's go through this. So no, 6% said you owe a duty to your clients. I totally get that. I'm not saying I agree with it, but I get that. No, because you're following your boss's instructions. Again, your boss asks you to do something, you are going to have heck to pay the next day if that boss finds out that you did not do what you are supposed to do. Yes, because you should have not taken a short position in APAC stock. Well, that is really kind of adding fuel to the fire. Not only are you going to trade on material non-public information for your clients, you are then going to use that information to benefit yourself. I see that 63% said, yes, you should not have sold APAC bonds, but how do you do that? You know what I mean? And I say this only because it's important for you as regulators to understand these are real life situations that investment professionals find themselves in. And as you can see from this situation, there really is no easy answer to this, you know? It's very, very difficult. We can say, oh yeah, you shouldn't do it, but you get a phone call and you're doing it. Let me just say, in the real life situation, we took it to a little bit of an extreme, but this person did sell the bonds from the client portfolios. I added the part about taking a short position in the stock, but again, I showed you that quote. The individual who faced the situation felt like they had no other choice but to do that. They felt like not only did they owe a duty to their clients, they also felt like they had a duty to their employer as well. And although they kind of realized that what they were doing was improper, they just did it and just hoped that they wouldn't get caught later on. So I have to ask you, for all 63% of you who said, C, yes, you should have not sold APAC bonds, what are you going to do? What are you going to tell your boss? No, I'm not doing it. I want to let my clients lose money, or what?
Sir Mike, on that note, I'd love to hear from Robert Richard Grizzle or his colleagues from the stock exchange, because there's a regulatory market oversight division.
Yes.
The same principle that applies for bonds also applies for stock. So I'd love to hear from them. One of them, that's whether they have any unique considerations to put on the table, given that they're normally looking from the other side, and sometimes there are hints that, you know, some stock trades that went through perhaps this whole same issue about material non-public information. So Richard or your colleague, it was good if you could just tell us if you have any unique considerations to put on the table. And then the other persons from BOJ and so can, you know, chip in, or FSC. But I'd really love to hear from somebody from the stock exchange. Just in terms of your any general perspective that you want to bring to a situation like this.
I think what I appreciate so far in what Mr. Macmillan has said is the whole idea of the challenge in making a determination of what to do in these ethical dilemmas. And I think what would help, where you have to, say, confront a superior, would be a suitable governance structure that facilitates communication of these sort of concerns. I'll stop there.
Okay.
All right, thanks, Richard.
You're welcome.
Thank you, Richard. Yes. And I will point out that one of the things that you always hear said all the time is it's tone at the top. It's tone at the top. The problem is at some of these financial institutions or so, you may have a CEO, a CIO, or a president who's the most ethical person in the world. However, as an employee, I don't come in contact with this CEO on a regular basis. Who I do come in contact with, however, is my middle manager. And it may be not the CEO who is encouraging me to do something unethical, it's my middle manager, it's my direct supervisor who's asking me. And this is where the problem breaks down. This is where the ethical pyramid, if you will, breaks down. In addition, I will say, as regulators, you need to be aware that it's the newer entrants into the industry that are often most vulnerable to be taken advantage of. If you look at the people who were prosecuted as a result of the global financial crisis in 2008, most of the people who were prosecuted were 20 and 30-year-olds, late 20s, early 30s, not senior managers or middle managers. Why? Because again, it's these 20, 30-year-olds who want to be team players, who want to get ahead, who have listen to their bosses, and then like in this situation, so you sell the bonds. You don't even think about it. Your boss says, listen, this is what I learned. I want you to get up tomorrow morning and sell the bonds. In many cases, people wouldn't even think about it. Well, my boss told me to do it, I do it. The problem is, suppose if this individual is caught selling the bonds, and they bring the individual in and they said, you were charged with insider trading. And the individual says, well, it was my boss who told me to sell the bonds. The boss can say, I never told him any such thing. I just told him about the ratings change, but I never told this individual to actually sell the bonds from client portfolios. So that's the person who really gets in trouble for that. All right?
Sorry.
Yes.
In that respect, then, do we get some written consent then from the boss before taking the action?
Well, what is it? What is that expression? Say it, forget it, write it, regret it. You know what I mean? So much of what's done, if you're going to ask somebody to do something that's unethical or illegal, you're never going to put it in writing, And again, think about the situation. It's 7 o'clock, it's 8 o'clock at night, and all of a sudden you get a phone call from your boss. Hey, blah, blah, blah. I just learned about a downgrade. I need you to sell these bonds from client portfolios in the morning. Boom, click. Most people would do it. Okay?
Michael.
Yes.
Colonel here. And I think on that basis, as regulators, we have a duty to ensure that there is a proper governance structure as well as culture that is actually spread across the industry, the company coming from the board. Particularly, this will be addressed with a strong code of conduct policy that actually states how you treat with certain scenarios, as well as require that when an employee is in doubt, they would refer to compliance or legal on those issues. So you'll find that if you have such a structure, it would actually not necessarily eliminate all the issues, but it will reduce it, I think.
Okay. All right, good. I got
one thing before you go. Just respond to Reynard also. What I've seen the more seasoned people do, not those who are new to the industry, but the more seasoned people, when they get those calls at 7 and 8 in the night, they send an email to the boss to say, this serves to confirm our conversation that I should say so and so. The boss usually, they they blow a fuse because they don't want it in writing. Exactly. And generally, they don't respond. But at least you have that as a defense to say, why would I take upon myself to write to the CEO to confirm a conversation if no conversation took place? So the boss will, the CEO will not respond. That has been my experience. But some persons have done that and then gone ahead with the unethical action, of course, because they're trying to preserve their jobs. So that's what I've seen in recent years.
Okay, as a protection mechanism.
Yes.
Okay.
The boss will be upset right now. The boss will be very upset because he doesn't want in writing.
Right. Thanks for that.
Sure.
One of the programs, just to digress for a second, one of the things that we're trying to do at CFA Institute, this workshop right now focuses upon awareness and analysis. Are you aware there's an ethical issue? Yes. What is the ethical issue? We also have workshops that focus upon action, and they start from the point about you are being asked to do something unethical. What should you do to address that situation? And so that's some of the things that we're talking, that Hugh mentioned, that Richard mentioned. Yes, if you were asked to do something unethical, one, you should make your boss aware that what they're asking you to do is unethical, and or you should try and get it in writing so that you protect yourself as well. So I think it's not only being aware of what's going on, but also giving people the tools to deal with the situation once they find themselves in it is equally as important. So, I was doing something to endanger your life, I guess. Yes, I do see that. All right, so here we go. I like this cartoon. It says, run this by the legal department, but run super fast so the ethics department doesn't see it, which is to my point earlier. There is the law, and then there's ethics. And the law is the minimum standard. Ethics represents a much higher standard. But
we're not seeing the cartoon. Could you just advance your slide? We're not seeing the cartoon.
Okay, you can't. Okay, hold on. You don't see it.
Not as yet. Is anybody seeing it?
Yeah, I'm seeing it.
Yes, I'm seeing it.
I'm seeing it.
Seen it.
All right.
All right, good.
All right. So I'm going to go on just a little bit. Now, let's talk about the difference between compliance and ethics, because I thought it was very interesting before that someone mentioned, oh, this person should consult the compliance and legal department. I agree always, but let me just bring this fact out to you. Since the financial crisis in 2008, every single financial institution around the world has doubled or tripled the size of their compliance department. Yet, every day when I pick up the Wall Street Journal or the Financial Times or the New York Times, I'm still reading about somebody at one of these financial institutions doing something that's unethical or in fact illegal. Now, this is not to to put down compliance people, because I think compliance people are very, very smart, educated, and capable people. However, what they're being asked to do is their primary responsibility is to ensure that everyone in their organization follows the rules, regulations, and procedures of that organization. It is not their responsibility to really encourage and see that employees live up to the values or the mission of the company. So again, compliance tells us what we must do. Ethics really focuses upon what we should do. And I think that role is the responsibility of top management as well as middle management as well. So I got one more for you. Here's another one that which I hope you enjoy. All right, so let me turn on the voting. All right. Okay, so you've recently been hired by a sovereign wealth fund to manage an emerging market real estate fund. The current portfolio manager of the fund, who is retiring, hires local sub-advisors to help find and secure investment opportunities in these countries. Although the sub-advisors have little investment knowledge or experience, they are familiar with local laws and regulations and have close relationships with high-ranking government officials and regulators. The substantial payments that the portfolio manager has made to these sub-advisors cover their deal fees and other expenses they incur to obtain governmental and regulatory support for the sovereign wealth fund's real estate investments. As a result, the sovereign wealth fund has made a number of large and successful investments in these countries. The portfolio manager has reported these payments as operating expenses to the sovereign wealth fund. So here's the question. Should you continue to make these payments? A, no, you shouldn't. B, yes, you should continue because it is acceptable to hire sub-advisors to assist in finding and securing investment opportunities in foreign countries. C, yes, you should continue because the sub-advisor payments are legitimate expenses to ensure the success of the investments and to protect the fund. D, yes, you should continue as long as the sub-advisors keep these payments confidential. Vote. All right, let's see what we're going on here. All right, we only got 2. Where is everybody else? All right. All right, come on, come on. All right, let's see how we're doing. All right, well, at least with what we have currently, there's some votes coming in. We would like to get up to 16. All right, so I gotta ask, just because of timing issues, is there an issue in this particular case? Anybody? Is there an issue in this particular case? Remember, this is going to be interactive, so I do want to hear what people have to say. Hey, Sharifa, have you answered? Have you read it? What did you say? This is just
I think Sarifa dropped off.
Yeah.
Yeah.
I see. How, anybody else want to volunteer an answer? How about Tracy Ann? Hello, Tracy Ann. You can answer. All right, Tracy Ann, let's answer. No response? How about, oh, Reynard?
Well,
thank you. Yes, sir.
The issue, there seems to be possible risk as it relates to politically exposed persons, money laundering. Those are the considerations that I thought about in looking at the scenario.
Okay.
While it might not be illegal to have sub-advisors when doing deals in other foreign countries, I would not be comfortable with the fact that these sub-advisors who were hired had little investment knowledge or experience, and basically the only benefit that they were offering was the relationship with high-ranking government officials and regulators. So on that basis, I wouldn't feel comfortable continuing those payments.
Great. Thank you very much. I think your analysis is spot on, because here is the point about this is, thank you very much, Renard. It is okay to hire sub-advisors in countries that you're not familiar with, that you want to do business in. That's perfectly fine. These sub-advisor payments may very well be legitimate payments. One, they shouldn't be kept confidential, as Dee says. Also, they are being listed as operating expenses to the Sovereign Wealth Fund. So that should raise a red flag. More importantly, as Reynard said, these local sub-advisors have no investment knowledge or experience. But what they're really being hired for is because of their close relationships with high-ranking government officials and regulators. So it could be that these payments that are being made to these sub-advisors are being funneled to government officials and regulators, perhaps in the form of bribes, so that they support or give their approval of these projects. Now, I know in the United States, it is illegal for anyone in the United States to bribe a foreign official, all right, anywhere in the world, bribing a foreign official by an American is absolutely illegal, and you'll get in trouble for doing it. So I think that there are enough red flags in this particular case so that this individual, the incoming portfolio manager, really needs to investigate what is going on, who these sub-advisors are, and where these payments are going. In addition, the portfolio manager should be provided with a detailed record of where all of the payments that the sub-advisors make, where all of these payments went to, who did they go to, and why did they go to. That still may not be sufficient, but that's at least a starting point. And by the way, do you have any, are there any laws or regulations about Jamaicans bribing foreign officials in other countries?
Well, I think there is one that has come up again with a Dutch company, Trafigura, and every time they try to put it, you put a fire out, it comes up again. So there are a lot of considerations as to whether or not but in fact, it's the other way around. It's a Dutch company that made a political contribution, and so there are different views as to whether or not they tried to bribe the party which is in opposition now, and this has been dragging on for probably close to 10 years.
Oh, okay, that makes sense. All right, so I think we have time for one more or two more cases. How are we on time, Hugh?
We're good. I think we can wrap in 15 to 20 minutes because we're mindful of everybody's time.
Okay, well, I'm going to skip one of these cases and start a new one because we are dealing with regulators, and I'd love to find out how you would feel about this. But before we do that one, let me just talk about some fundamental ethical principles. These are globally shared ethical principles as they involve the investment industry. The first one is that client interests come first. Second one is it's important for investment professionals to always maintain their independence and objectivity, not only to maintain it, but also to maintain the perception of their independence and objectivity as well. We should always strive to avoid conflicts of interest, but as you know, many conflicts of interest in our industry can't be avoided, in which case those conflicts must be managed. And what's the best way to manage a conflict of interest? It's through full and fair disclosure so that the client has the opportunity to make an informed decision one way or the other. Preservation of confidentiality in this day of the internet, of Facebook, Instagram, LinkedIn, etc., maintaining not only client confidentiality, but employer confidentiality is very, very important. Fair dealing. When we talk about fair dealing, we mean that one client or a group of clients should not be disadvantaged to benefit another client or another group of clients. So all clients should be treated fairly. Last one is reasonable care and prudent judgment. So when investment professionals are conducting research or when they're making recommendations, they should use reasonable care and prudent judgment in conducting or performing those activities, right? Fundamental ethical principles. And as a matter of fact, those principles are embodied in the CFA Code of Ethics and standards of professional conduct. And I dare say many of the laws and rules that have been enacted, not only in Jamaica, but in the US and in other parts of the world, really reflect many of those fundamental ethical principles. So I'm going to skip this one and I'm going to go to this one because I really want to hear how you view this. All right, so here is the situation. You are a securities analyst at an investment firm. One day you have lunch with a friend who is the executive assistant to the president of microtechnology. During lunch, your friend tells you that she has been working late because her boss has been meeting with the president of Pambex Systems. After returning to your office, you learn that Pambex is rumored to be a takeover target, so you purchase shares of the company for your personal portfolio. Later in the day, you tell your boss about the conversation that you had with your friend. Your boss observes that there has been heavy buying of Pambex shares recently, so he purchases share of Pambex for the firm. Now, should you or your boss have purchased shares in Pambex? A, you and your boss were free to purchase shares. B, only you should have purchased shares. C, only your boss should have purchased shares. Or D, neither you nor your boss should have purchased shares. So I'm going to give you a moment to think about this and then to vote. All right, let's see what you said here. All right, we got 10. All right, come on, let's get some more in there. All right. And I love these results because the results are sort of binary. Either people said neither you nor your boss should have purchased shares, or people say you and your boss were free to purchase shares. So we love this, your answers. Okay, so now let's talk about this. And someone tell me what they believe are the issues in this particular case. How about, oh, there's Sharifa, she's back. Hey, Sharifa, you want to answer this question?
Hello.
Hi.
Hi.
Yeah.
You keep catching me off guard, you know, but in any case,
yeah.
And this might be completely wrong, but I'm just thinking there was no disclosure of confidential information or an internal analysis that was shared with the friend. So the friend got some information, she put 1 and 2 together and realized, oh, this might be happening. But she wasn't given any information that led to her purchase. It was her own analysis and the boss's own analysis, albeit it was based on information that they got, not critical information that they got from the friend. And so I don't think they were wrong in going ahead and to purchasing shares. It's like, I see I see that it's raining and I go and plant flowers. I don't see anything wrong with that. That's not insider trading. That means I am being perceptive and see that, it's getting dark, so it's going to rain and it's the best time to plant flowers. So God didn't whisper to me and say, hey, it's going to rain, so plant flowers today. So that's kind of my mindset, but it might be wrong, but hey.
No. And see, that's one of the reasons why we make them ambiguous enough so that they encourage discussion. So I would assume that you answered A?
Yeah.
All right, good.
I could have answered A.
All right. So who answered D? Who answered D? And the results say that 67% of you said D. So who said D? Come on, step up to the plate. Who said D? How about Lloyd? Lloyd, what did you say? Hello, Lloyd. Lamar? %67% of you said D. Okay, all right, so here is the issue. And Sharifa said it perfectly, is this material non-public information or is it not? Okay, so in this particular situation, the only information that this analyst got from the friend was that the president of these two companies had been meeting late at night. That's the only piece of information. Now, we know that this information is non-public because the world doesn't know that they've been meeting at night. The question is this material non-public information? And I would say no, because as an example, the president of Tesla, the car company, is a gentleman by the name of Elon Musk. And as you may know, the president of Apple Computer is a gentleman by the name of Tim Cook. So the question is, if you learned that Tim Cook and Elon Musk had been meeting, and just on that information, would you go out and buy either one of those stocks? And the answer, stocks of those companies. And the answer is probably not, because that's it, they're just meeting. However, what you did and what was done in this case was you took the fact that they were meeting and then you combined it with this rumor of a takeover target, and both pieces of information you used to base your investment decision on. And I have to tell you, there is a theory that we call the mosaic theory. And the mosaic theory says that you are allowed to use non-public information as long as it's not material, and combine that non-public information with public information to base your investment decision on. Now, here is why I like this case, especially for regulators, because let's suppose you buy Pambeck stock, You buy it in your personal portfolio, as the case says. Let's suppose 3 days later, Microtechnology announces a takeover of Pambeck Systems and your stock goes through the roof. Now, as regulators, what would you do with this person who just so happened to buy shares in Pambex 3 days before the takeover was announced? Would you investigate this individual? And I would say probably yes. You see, in the US, the Securities and Exchange, yes? Comment? In the US, the Securities and Exchange Commission, our regulator, would probably send this individual what is known as a Wells notice. And not only would they send the Wells notice to the individual, they would send the Wells notice to the individual's firm. And the Wells notice basically says is that you are under investigation for trading on material non-public information, and you need to get a lawyer and come down and explain to us exactly how and why you just so happened to make this trade right before the takeover was announced. So what's going to happen? This individual is going to hire a lawyer and go down to see the regulator. In addition, this firm, this investment firm that this analyst works for, is probably going to let this analyst go. Why? Because the firm doesn't want its name to get involved in any sort of insider trading scandal. So they said, you're under investigation. We don't want to be involved. We're going to let you go. But I got to tell you, as someone who just made a fortune off of investing in Pambeck Systems, you're not particularly upset by that because you got a lot of money as a result of the takeover. So what happens? You go down to the regulator, and the regulator, SEC, charges you with material trading on insider information. And so for the next 6, 9, 12 months, you go to court with your team of lawyers battling this charge. And finally, after about a year or so, the judge may say, you know, you're right. This was an example of the mosaic theory. You're not guilty. But what good is this? Because at this point, you've spent a lot of money, a lot of that money that you got from the takeover on lawyers and going to court and things like that. So now you probably need another job. You're going to take that not guilty verdict, you're going to staple it to your resume, and you'll start looking for another job. Do you think any firm is going to hire you once you've been under investigation for insider trading? Probably not. So one of the lessons from this sort of case is, when in doubt, don't do. Because although you could win the war, you may lose the battle. And the battle may be more important than the overall war, and you'll find yourself in a worse position at the very end. Okay? All right, so I have a couple of last minute comments that I wanted to wrap up. And that has to do with rationalizations. Remember I said earlier that we tend to view ourselves as more ethical than we really are. So when we rationalize our actions, it means that we are providing justifications or reasons for not taking the right course of action. Well, I'm not going to report my boss for copying the files and sticking them in her briefcase because she hired me, she mentored me, she's being unfairly let go. She needs this information to find another job. All rationalizations. To neutralize ethical intent by reducing the negative effect that accompanies performing an unethical act. You know, we are all basically good people. So when we do something that's unethical, we often feel guilt about it. We often feel bad. So we've got to rationalize why we did it to get rid of that guilt. To justify behavior that is inconsistent with our own opinions of ourselves. As I said, we view ourselves as really ethical. So we now have got to think about reasons why the behavior we just exhibited is inconsistent with our ethical image. And to change, we use rationalizations to change our perception of a situation or social environment so as to defend our behavior. Here's a great quote. There's never been an act done since the beginning, from a kid stealing candy to a dictator committing genocide, that the person doing it didn't think he was fully justified. That's a mental trick called rationalizing, and it's done the human race more harm than anything else you can name. So here's some common rationalizations. Everybody else does it, so it must be okay. That's the way they do it at firm X. If we don't do it, somebody else will. This is the way it's always been done. It doesn't really hurt anyone. It's not a big deal. He or she deserved it. And this last, it's not my responsibility. Not my responsibility to report someone. This last one, I want to be a team player. I want to be loyal. If you hear yourself or anyone else saying any one of these phrases, then you both need to stop and think about what you are about to do, because it may be that you're justifying behavior that you know deep down is inappropriate or unethical. So I am going to leave you with the last two things. How do you resolve an ethical dilemma or resolve ethical dilemmas? Well, first you have to acknowledge that there is an ethical issue. And sometimes we see emotion, we see obedience to authority, we see all of these other things, but the true underlying issue. So to resolve an ethical issue, you first have to acknowledge that there is one. Second thing is, you have to determine who's faced with and owns the problem. In the case of the files, even though, in the second files case, even though you are observing what the boss is doing and you're not actually copying the files, that problem still becomes yours when you witness someone who is doing something improper. You actually have a duty to report that or do something about it. Gather the relevant data. Well, in the case of PAMBEC systems that we talked about earlier, the question was that material non-public information or wasn't it? So gather the relevant data. In the case of the sub-advisors, were those payments for bribes or were they legitimate payments? You need to do research and figure that out before continuing the payments. When I say number 4, test the wrong versus right parameters, ask yourself, is this legal? Can I do this? Can I not do this? When I say in number 5, test for the right versus right paradigm, I mean, ask yourself, is this ethical? Should I do this or should I not do this? Apply the resolution principles. Am I putting my client interest first? Is this going to affect my independence and objectivity? Am I fully and fairly disclosing all the information my client needs to know to make an informed decision? Investigate other options, compromise, as so many of you have said. Sometimes the solutions don't have to be binary, meaning do it or don't do it. There may be compromises or other alternatives that are available to you. Make a decision and then reflect on what you've learned from the decision. Because here's the point. We're never going to make the right decision 100% of the time. Let's just hope we make the right decision 60% of the time. Regardless, it's important to reflect on the decision that you made, because there's always something valuable or useful that you can learn from that decision, which is going to enable you to make better decisions in the future. So I'll leave you with this last quote from Warren Buffett, who said, "I want employees to ask themselves whether they are willing to have any contemplated act appear the next day on the front page of their local paper, to be read by their spouses, children, and friends, with the reporting done by an informed and critical reporter." So I have one more task for you to do before we go. If you look on your phone, there I have opened up a ethics training workshop feedback. I would love for you to fill out this questionnaire. There are only 3 questions. They're anonymous, and I don't see what the results are. But through your feedback, we can make these workshops more informative and hopefully more effective for you. So please take a moment, fill that out. I thank you all for your participation, and I will turn this over to our host, Hugh Miller. And thank you, CFA Society for Jamaica, for inviting me and my colleague, Nicole Lee, and for allowing us this opportunity to conduct this workshop.
Okay, Mike, I don't know. There are many ways to say thanks, and I think we utilize all those this morning. Just on behalf of the participants from the Bank of Jamaica, the Stock Exchange, and the Financial Services Commission, because I think this workshop comes at an ideal time as the local financial sector, whether it's the commercial banking sector or the securities market, is going through an evolution, it's developing, and some of the consideration which you raised this morning, I am pretty sure that the participants as well as their colleagues will be able to apply them within the not too distant future as they face some real life ethical dilemmas in the days and the weeks to come. So we wanted to thank you, Mike, as well as Nicole. And I just say this, that we will find a way to show our contribution in a tangible way, even though you're far removed and even though there are restrictions in terms of travel. But you have journeyed with us for the last 3 days, starting on Wednesday with the pension trustee workshop, yesterday with the industry practitioners, and today with the regulators workshop. So in due course, we'll find a way just to show our contribution in a very tangible way. So again, we thank you on behalf of the participants today. And I'm sure this relationship is just getting started. So we are pretty much embarked on a long-term relationship. So thank you both and have a good day. And to the participants, thank you for being attentive and have a good day. Have a good weekend when it comes also. And please stay safe, you all.
All right, thanks. Bye.
Bye-bye.
All right.